Hello and welcome to this episode of Capital Markets View, the first for 2020. Hello Taron, Happy New Year.
Happy New Year to you too.
How are you? How was it? Fun?
Yeah, it was not that relaxing with a 1-year-old, but it was a nice break.
So we were up late for different reasons perhaps. Right, okay, volumes, European volumes, so 95 versus 80, still not bad, and a good last quarter.
When you look at the overall last 10 years, it was a very good.
Yeah. But America, so I just got to refer to my notes, 435 for the year before, whereas 310 for 2019. That's quite a significant drop.
Yeah, and so we think that the driver in the U.S. has really been the fact that there hasn't been a lot of big M&A. There's been a downturn in that, and then it's been difficult for single B credits because there has been this bifurcation, this flight to quality, a lot of outflows in the retail mutual funds.
And actually, they have more double B issuance in America than we do here.
Yeah, and a lot of appetite from banks for that. So, so that's been a real difference in the markets.
So when you say flight to quality, it's people taking the double Bs, not the single B.
Yeah,
it's a broader, wider market. Pricing, so stable at about 4% yield here. Personally, I think it's going to stay about the same.
Okay.
Depends on supply and demand.
Yep, as it always does.
In the secondary market.
Yeah, I just wanted to include this slide just to show that we did have a bit of a ropey autumn for both markets. But at the end of December, there was improved secondary demand, specifically.
Slight upticks both places.
Yeah,
both
and in Europe,
America.
I think it was helped by the election, and so some clarity around Brexit.
Yeah.
And just investors also taking, trying to get into some positions before a very quiet Christmas without a lot of new issuance until January planned.
And so here we go with the credit stats, so debt to EBITDA. And then as we've already mentioned, not quite as many very highly levered deals as the year before.
Yeah.
So even though people are worried about docs and credit, actually this shows you, although this is sales pitch, this is information memorandum.
Yeah, and it's also like there haven't been as many jumbo M&A deals, and so we haven't seen as much leverage from those as well. That often drives it. So
this year again, I would predict that probably is going to be flat. I don't see we're going to have massive increase in highly levered deals, but let's see what happens.
Yeah.
Okay, so I'm very happy to say at S&P we are mainly issuing single B flats.
Okay.
Not B minuses. I know you've got some stuff to say about triple Cs, but it's still a very small percentage of certainly new issue.
Okay.
American CLO issuance, another good year.
Yeah. Strong year. I think what we've written about predictions in terms of what the market is predicting is that it'll probably be maybe a little less, because of the sort of, is there going to be enough supply in terms of loans to support all the new managers that have come into the market? But I mean, that's also a positive thing that there are new managers, and it's a bit chicken and egg. Maybe that will drive some of the single B demand for them.
And in Europe, 30 billion, so
another record
really
year.
Good year.
Yeah, fourth record year.
I think it will be flat this year, actually. That's my prediction. Although every CLO manager has a warehouse open, if not more than one warehouse. There's 40 to 45 managers in Europe. New European managers, American managers are coming in. So, I just generally feel this year will be good, but flat.
Okay.
Cross-border down a lot.
It's down a lot. We recently published a report on this, and it's interesting because I think there hasn't been as much jumbo M&A that needs that sort of cross-border syndication. But if we see bigger deals, there are actually 3 big cross-border deals out, including the Cobham one from the UK. So positive noises that we'll see more cross-border M&A, and that could drive supply to meet this demand that we're seeing from investors, because we still very strong demand in Europe in terms of CLOs, but also non-CLO demand.
Let's see where it goes. And then you did a default study at the end of last year.
I did, in case people didn't see it before Christmas, I did a default study, surveyed investors.
And that's an annual survey,
It's an annual survey in the market of investors. The consensus, or the average, was 1.6% by the end of 2020, and that defaults won't move back to the long-term average until 2022.
Okay.
And that's the long-term average is 3.5%.
So relatively
of the LE.
benign economic environment still.
And I think the reason for that is obviously this cov light. It's going to have to be liquidity for companies, a liquidity crisis for a company to default, and also I would say the word that people said to me often was idiosyncratic. So it's not going to be a whole sector that defaults. It's going to be those companies that are really having difficulty, potentially because of disruption. They're having trouble with it's not a great business model. So it's not, it's not like the last crisis where we're going to see, or last default cycle where we're going to see like a whole industry wiped out by it. And this is a distress ratio. So even though we're not seeing defaults tick up, and you mentioned triple C's, we've been seeing more downgrades in the LE from single B to triple C, and then this distress ratio, which is credits under 80, has been ticking up. So there are signs of stress.
So the trend's up, even though forget that little downward blip at the end. It's an upward trend.
Yeah, and investors are saying they're seeing more signs of stress in their portfolio, definitely.
Okay. Well, and there are rumblings in CLO world about people wanting bigger triple C. Well, there's somebody that's looking at more triple C, and people are starting to think about it. Still don't think it's going to happen for a little while. Maturity wall.
Yes. We haven't seen this for a while.
No, blast from the past.
For ages. Yeah, but I think what's interesting about this is that you and I were talking about how we would expect 2024, that red bar, to be lower, that more investors being proactive in terms of.
Well, it looks like nobody's done anything for those vintages.
Yeah, and rates, as we're talking about, are low, and we may see more refinancings as investors try to deal with this in the first half of this year. And
also, we certainly saw this on the rating side. I know you've seen it as well. The stuff that happened in the last quarter of last year was pure pricing change.
Yes, we saw a huge uptick in repricings.
Yeah, no maturity push-outs, no little extra bits on the term loan B, just price.
Yeah.
Okay, and Happy New Year.
Thank you
again. So Happy New Year to everybody who looks at this. Thank you very much. Please tell your colleagues that you have to register now to watch this video. Don't worry, doesn't mean all kinds of things are going to fly your way into your inbox from S&P. Healthy, wealthy and Happy New Year to you and your family. As ever, any questions, please talk to me or Taron. Thank you.